Imagine you've saved $1 million, or, maybe 1 million raised.
Right.
You're finally ready to step back, relax, and you want to know exactly how much can you withdraw every single year to live comfortably without ever running out of money before you die.
It's the ultimate question.
Yeah. And for decades, the magic, undisputed answer in the financial world was 4%. But what if that golden rule was actually just a historical anomaly, like a lucky stroke of 20th century American economic dominance?
I mean, it is a premise that challenges one of the most deeply held beliefs in retirement planning. If that 4% foundation cracks, an awful lot of retirement spreadsheets suddenly just don't add up.
Exactly. Well, welcome, everyone. It is Tuesday, April 21st, 2026, and you are joining us for a deep dive based on fresh research and data we compiled just yesterday on April 20, 2026.
Yeah, this is Macroeconomy AI, and today's broadcast is titled Looking into the 4% Rule.
And we've got a massive stack of sources today. We are pulling from William Bengen's original paper, the famous Trinity study, Wade Pfau's global financial data.
Oh, and the forward-looking projections from Morningstar. Plus, some really fascinating modern stochastic models looking at the Brazilian market.
It's a really comprehensive look. And the goal here isn't just to, stare at the numbers, but to understand the underlying mechanics of why those numbers behave the way they do across different timelines of different countries.
Right, exactly.
We are so glad you're tuning in to explore this with us. If you're listening to this and planning your own future, you're probably going to want to take notes.
Yeah, definitely get a PIM.
Please make sure to like, comment, and share this deep dive if you find it valuable. Before we jump in, a quick word about our sponsor. Today's deep dive is brought to you by Sponsor Name.
Yes, thank you to them.
And just as a quick reminder of what we do here, Channel. Macroeconomy AI is bringing a compilation of analyses and news on macroeconomics, technology, and artificial intelligence. Now, back to our sponsor. They are offering an incredible deal for our listeners today.
Highly recommend checking that out. So should we get into the mechanics?
Let's do it. Okay, let's unpack this. The 4% rule. For anyone who has ever used a retirement calculator, this is basically the bedrock, right?
Oh, absolutely.
The core concept is wonderfully simple on the surface. You have a portfolio. Let's use that $1 million example. In year one of your retirement, you withdraw 4%, which is $40,000.
Right.
But here's the key. In year two, you don't calculate 4% of whatever your remaining portfolio is worth. Instead, you just take that original $40,000 and adjust it for inflation.
Which is a huge distinction.
Yeah. So if inflation was 3%, your year two withdrawal is $41,200. You keep doing this, blindly adjusting for inflation, and supposedly this strategy ensures your money lasts for at least 30 years?
That is the popular understanding, yes. But if we look at the origin story in our sources, there's a massive, almost universal misconception about where this rule actually comes from.
Wait, really?
Yeah. If you ask most finance professionals, they'll point you to the famous Trinity study from 1998, written by Cooley, Hubbard, and Walls, but they didn't invent it.
Oh, wow. I actually thought they did.
Most people do. The true architect of the 4% rule is actually a financial advisor named William Bengen, who published his seminal paper 4 years earlier, back in 1994.
And reading through these papers, the distinction between Bengen's 1994 original work and the 1998 Trinity study isn't just, like, trivia. They are answering two fundamentally different questions, using different math.
Entirely different methodologies, yeah. Bengen built his model using a 50-50 split of the S&P 500, so large American companies, and intermediate-term government bonds, specifically 5-year bonds.
Yeah.
He ran the historical market data from 1926 to 1992, and Bengen was looking for an absolute floor. He calculated something he called the safe max rate.
The safe max rate?
Yeah, the absolute highest withdrawal rate that would have survived every single historical period. And that number actually came out to 4.15%.
Right, but then the Trinity study comes along in 1998 and changes the parameters. They swapped out the 5-year government bonds for long-term, high-quality corporate bonds.
Exactly.
But more importantly, they weren't looking for an absolute guarantee like Bengen was, right?
Precisely. The Trinity study didn't find a perfect safe maximum. Rather, they found that a 4% withdrawal rate had a 95% success rate of surviving a 30-year period.
So 5% of the time, the portfolio still blew up.
Exactly.
Okay, 95% is great, but it's not 100%. And this brings us to what I think is the most misunderstood part of Bengen's original 1994 work. When he found that 4.15% safe X rate, he wasn't looking at normal economic conditions.
No, not at all. What's fascinating here is that Bengen explicitly stated that in average historical conditions, a safe withdrawal rate would actually be around 7%.
7%? That's huge.
I know, right? And in boom times, maybe even up to 13%. The 4% rule was calibrated specifically for the absolute worst-case scenario the American market had ever seen.
And by worst case, we are talking about someone who retired in 1968.
Yeah. Think about the economic nightmare that followed 1968. If you retired then, you walked right into the brutal 1970s stagflation.
Oh.
That is the devastating combination of double-digit inflation eating your purchasing power while the economy simultaneously stagnates. And then right in the middle of that, you get hit by the massive 1973 to 1974 stock market crash.
Where the market lost, what, nearly half its value?
Yeah, almost exactly half. So Bengen found that 4% was the mathematical limit you could withdraw if you had the terrible luck of retiring exactly into that 1968 meat grinder.
Which means the 4% rule isn't an average at all. It's a bunker.
It makes me think of structural engineering.
How so?
Well, you don't engineer a bridge for a sunny day with a light breeze. You build it to survive the worst 100-year storm on record. Bengen engineered a financial bridge to survive a 1968-style economic hurricane.
That's a really good way to frame it. But it makes you wonder, does the bridge hold up if the weather fundamentally changes? Because while the math looks beautiful on a 1990s spreadsheet, the reality of pulling cash out of a live market is incredibly messy.
So messy. Which brings us to the first major structural crack in the 4% rule. It's something called sequence of returns risk.
Ah, yes.
A very detailed 2013 study by researchers Fink, Pfau, and Planchette highlighted exactly how dangerous this mechanism is. We tend to think of average returns. You hear people say, oh, the market averages 8% a year, so pulling out 4% is perfectly fine.
Right, sounds totally logical.
But the math doesn't work like that when you are actively withdrawing money. When you get those returns matters just as much as what they average out to.
I think the best way to explain sequence of returns risk is to imagine you have an apple tree that produces a steady crop of apples. If you just harvest the apples, you're fine. But if a harsh winter hits like a market crash, and the tree stops producing apples, you still need to stay warm. So you start chopping off branches of the tree itself for firewood just to survive.
That is exactly the mechanism. If you retire and the market immediately crashes by 20% in your first 2 years, you still have to pay for your groceries, your housing, your life.
You can't just stop eating.
Right. So you are forced to sell your assets. You are chopping off the branches at a steep loss to generate that $40,000.
And the permanent damage happens because when the sun finally comes back out and the market recovers, your tree is half the size.
Precisely. You have fewer shares left to capture the upside of the market recovery. The compounding engine of your portfolio is permanently impaired.
Wow.
Yeah, sequence of returns risk means a bad first few years can permanently cripple a portfolio, even if the long-term average return over 30 years ends up looking perfectly fine.
And what if that timeline isn't just 30 years? Let's bring in the FIRE movement here. Financial independence. Retire early.
Oh, this changes everything.
Right. We have thousands of people aiming to retire at 40 or even 35. A 30-year horizon only gets a 40-year-old to age 70. That's just not going to cut it.
The longevity reality completely shifts the underlying math. If you extend that timeline to 40 years, the 4% rule shatters because you are extending the time horizon where a bad sequence of returns can ruin you.
Yeah, that makes sense.
We looked at Morningstar's extensive 2024 and 2025 simulations. When they stress-tested a 40-year retirement horizon, the safe initial withdrawal rate plummeted from 4% down to just 3.1%.
3.1%. If you're listening to this and planning to retire early, hearing 3.1% probably makes you sweat. That is a massive difference in quality of life.
It really is.
If you wanted $40,000 a year at a 3.1% withdrawal rate, you don't need $1 million anymore. You need roughly $1.3 million. And it gets worse because there are other massive realities ignored in that original 1994 spreadsheet, right?
Very significant ones. Bengen's original model existed in a frictionless mathematical vacuum. It completely ignored management fees, transaction costs, and crucially, taxes.
Oh, taxes. Always taxes.
Always.
Yeah.
If you have your money in a traditional tax-deferred retirement account, you don't get to keep the whole $40,000 you withdraw. To actually put $40,000 of spending power into your checking account, you might need to withdraw $50,000 from your portfolio to satisfy the tax authorities.
Wait, let's look at that math for a second. If I have to pull $50,000 out of my $1 million portfolio just to net $40,000, my actual withdrawal rate is suddenly 5%, not 4%.
Exactly.
And 5% dramatically increases the risk of going broke over 30 years, not to mention the behavioral risk.
Oh, the human element.
Yeah, the 4% rule assumes you are a robot. It assumes you will calmly rebalance your portfolio, selling bonds to buy stocks while the market is down 40% and the news is screaming that the global financial system is collapsing. It assumes a level of emotionless discipline that almost no human possesses.
And that human element, that rigidity, is exactly why some of the most prominent academic economists have pushed back incredibly hard against the 4% rule. They argue it doesn't reflect how humans actually behave or how economic theory says they should behave.
Who are the heavy hitters leading this critique? Because I know this isn't just like a French debate.
Well, you have Lawrence Kotlikoff, a major proponent of a concept called consumption smoothing. He argues that the 4% rule completely ignores basic economic rationality.
Consumption smoothing. Okay.
Yeah, it's the idea that people naturally adjust their spending based on their wealth and income.
Yeah.
If you lose your job in the real world, you eat out less, you cancel subscriptions.
But the 4% rule doesn't do that.
Exactly. If your portfolio drops by half, economic theory dictates that you should adjust your spending downward to protect the underlying asset. But the 4% rule stubbornly insists you just keep taking your original $40,000, increasing it by inflation every year, essentially marching straight off a financial cliff. Then you have Nobel laureate Bill Sharp, who attacks it from the other side. He calls the rule inefficient.
Inefficient. How so? I mean, if it keeps you from going broke, isn't it highly efficient?
Because it's an incredibly blunt instrument. If you blindly follow the 4% rule and the market performs even reasonably well-meaning, you avoid that 1968 worst-case scenario, you have a very high probability of dying with a massive unspent surplus.
Oh, I see.
We are talking about dying with multiple times your initial starting wealth. Sharp argues this means the retiree unnecessarily sacrificed their quality of life. They could have been traveling, helping family, or simply enjoying the money they worked decades to save.
But instead, they hoarded it.
Yeah, because a rigid mathematical rule told them to act as if a massive depression was always just around the corner.
Okay, so economists hate its rigidity. But surely the historical data proves it works, at least in the United States.
Well, the key phrase there is, in the United States. If we connect this to the bigger picture, was the U.S. just uniquely lucky in the 20th century?
That's a scary thought.
To answer that, we have to look at Wade Pfau's brilliant 2010 study. He didn't just look at America, he examined 109 years of financial market data across 17 different developed countries.
And this is where it gets incredibly eye-opening, because the U.S. basically won the 20th century economically. If I retired in Germany or Italy or Japan, did this math still save me, or did it bankrupt me?
The international data is stunning and, frankly, quite sobering. Using a 50-50 stock and bond allocation, the 4% rule failed in almost all of the 17 countries at some point.
Wow.
It worked historically in a very select club, the US, Canada, Sweden, New Zealand, and Denmark.
But what about the others? What about, like, Italy?
In Italy, the 4% rule had an 80.5% failure rate.
80.5 to
Yeah,
fair.
and in Germany, if you look at the entire period from 1900 to 2008, the maximum safe withdrawal rate was a measly 1.14%.
1.14%. That means to get $40,000 a year, you'd need over $3.5 million saved.
Exactly. Now, to be fair, if you isolate Germany's post-war reconstruction period from 1955 to 2018, the economy recovered and a 4% rate worked. But over the long arc of history, relying on 4% in mainland Europe was often a recipe for bankruptcy due to wars, hyperinflation, and massive systemic shocks.
So what does this all mean? To me, it sounds like the whole premise of the 4% rule suffers from massive survivorship bias.
It really does.
The historical databases we use to run these spreadsheets naturally exclude markets that completely collapsed, places like Argentina, Russia, or China in the 20th century. We are building our entire philosophy of retirement on the shoulders of the exceptional, victorious 20th century American economic engine, and assuming that engine will run perfectly forever.
That is exactly the conclusion many modern researchers are drawing, which is why major institutions in the 21st century are fundamentally revising how they calculate safe withdrawal rates. They are moving away from just looking backward at historical data and instead trying to project forward using sophisticated modeling.
And Morningstar has been at the forefront of this, right? They publish these forward-looking yearly updates now.
Yes, Morningstar uses what are called Monte Carlo simulations.
Okay, let's explain Monte Carlo simulations for a second. It's essentially like looking at millions of alternate futures, right?
Basically.
A Monte Carlo simulation doesn't just look at the actual historical timeline. It takes all the historical returns and randomizes them, running thousands and thousands of different potential market scenarios to calculate the mathematical probability of your portfolio surviving.
That's a great way to put it. They estimate future asset returns and inflation, run the simulations, and their recent numbers show exactly how sensitive this rule is to current economic conditions. In 2021, when interest rates were sitting near zero and stock market valuations were sky high, Morningstar warned that the safe withdrawal rate moving forward was actually only 3.3%.
Because bonds were paying almost nothing. I remember looking at that 2013 simulation by Finke and Fau regarding low bond yields. They tested a scenario where real yields on bonds were negative. Let's break down why that is so devastating. If inflation is 3% and your government bonds are only paying 1%, your real yield is negative 2%. You're losing purchasing power every single year, safely locked in bonds.
And the math reflects that drain. In that negative real yield environment, the failure rate of the 4% rule didn't just creep up. It jumped from a historical baseline of 6% to a staggering 57%.
57% failure. That's a coin flip.
If bonds aren't paying a yield above inflation, the fixed income side of your portfolio becomes a dead weight, and the math just disintegrates. You're essentially eating your own principal to survive.
Which brings us to 2025 and 2026. Inflation moderated. Bond yields climbed back up. Where does Morningstar put the number now?
They've settled just under the line, projecting a safe rate of around 3.9% for a 30-year horizon, citing that while bond yields are better, equity valuations are still quite high.
This raises a massive question about geography and market environments. We've talked about the United States, and we've talked about Europe, but how do these mechanics operate in emerging markets, where the underlying economic physics are entirely different?
That is a fascinating shift in perspective.
Here's where it gets really interesting. What happens if we take this purely American concept built on S&P 500 data and U.S. Treasuries and drop it into a high-interest, high-volatility environment, like Brazil?
It completely flips the traditional script. In the U.S., retirees generally have to take on significant stock market risk to outpace inflation because American government bonds rarely yield high real returns. In Brazil, the dynamic is vastly different.
Okay, so what does the data say?
We looked at the only available peer-reviewed academic study on this exact topic for the Brazilian market, published in 2023 by Pereira and Perlin at the Fundação Getúlio Vargas.
And what did they find using actual academic rigor?
They used a process called stochastic programming. Unlike a Monte Carlo simulation, which just rolls the dice thousands of times to see what happens, stochastic programming is an optimization model.
Like a GPS.
Think of it exactly like a GPS routing software for your money. It maps out the uncertain future variables like inflation and asset returns, but actively calculates the optimal decisions to make at each step to reach the destination without running out of money.
That sounds incredibly advanced.
It is, and using this model, they concluded that a 5% withdrawal rate is actually sustainable in Brazil.
But the kicker is how they get that 5%.
Exactly. That 5% rate is achieved using a portfolio made mostly of fixed income.
That is wild to an American investor. A higher withdrawal rate with less stock market risk. But wait, I also saw data from the FIRE community in Brazil that was far more aggressive than the academic study.
Oh, yes.
There was a popular blog, AA40, that ran the math in January 2025. They looked at the first full 30 years of the Plano Real from 1995 to 2024.
And what parameters did they use for their model?
They used a 50-50 split. Half the money in the Ibovespa index, which is the main benchmark for the Brazilian stock market, and half the money tied to the CDI.
And the CDI is the interbank deposit rate, which essentially serves as the baseline for fixed income returns in Brazil.
Exactly. When they ran that 30-year period, they found a jaw-dropping safe withdrawal rate of 8.48%.
8.48% is incredibly high. It means you could pull over $84,000 a year off a $1 million portfolio safely. But we have to deeply understand why the math produces these numbers in Brazil.
Right, it's not magic.
No, it comes down to structural differences in the economy. Historically, post-stabilization, Brazil has offered exceptionally high real interest rates. We're talking about periods where the real rate, the rate you earn after accounting for inflation, was over 4%. Long-term government bonds, like the Tesouro IPCA Plus MA, routinely yield over 5% above inflation.
So in the Brazilian model, the government bonds are doing the heavy lifting. In America, you rely on the stock market to grow your money, and bonds are just shock absorbers. In Brazil, the risk-free asset itself is an engine for massive real growth.
Exactly. The country's baseline interest rate, known as the Selic rate, is kept high by the central bank to control inflation. Ironically, if you look at the expected returns in Brazil today, roughly 6.4% real returns for fixed income, 11.3% for equities with 4% inflation, it actually bears a striking resemblance to the exact 1994 U.S. economic environment that William Bengen originally studied when he created the 4% rule.
But,
Right.
and this is a massive flashing neon, but we have to emphasize the caveats here. If you are listening to this and thinking about applying an 8% withdrawal rate to your Brazilian portfolio, we need to pump the brakes immediately.
Yes, please do.
There are unique structural risks to this data.
Immense risks. First and foremost is statistical reliability. Brazil only have 30 years of reliable economic data since the Plano Real stabilized the currency in 1994.
Which isn't a lot of time in the grand scheme of things.
Right. Prior to that, Brazil experienced devastating hyperinflation, which renders the older financial data basically useless for these kinds of long-term projections. In the world of Monte Carlo simulations and historical backtesting, 30 years is a blink of an eye.
Right. You cannot run robust, independent, overlapping 30-year retirement scenarios when you only have exactly one 30-year window to look at. It's statistically impossible to know if 1995 to 2024 was an anomaly or the baseline.
Furthermore, you have extreme regulatory and tax instability. The rules governing how investments are taxed can change overnight. You also have massive currency volatility.
Oh, yeah.
If your retirement expenses are priced in reais, but you want to travel internationally or buy imported goods, a sudden devaluation of the real against the dollar can completely blow up your withdrawal math.
And perhaps most importantly, there's a structural risk to the Brazilian model itself. That massive 8.48% safe withdrawal rate relies almost entirely on the historical anomaly of the Selic rate, providing huge real returns.
What happens if that changes?
Exactly. What if the Brazilian economy structurally changes? If Brazil's interest rates ever permanently converge with international standards and drop significantly, that high-yield fixed income safety net will vanish. Portfolios tied to it might behave very differently, and that 8% withdrawal could bankrupt you in a decade.
So we are back to the engineering analogy. Building a retirement plan on 30 years of Brazilian data is like building a bridge based on only 30 years of weather data, hoping the climate never, ever changes.
Which brings us to the ultimate synthesis of all these sources.
Yeah.
After looking at Bengen, Trinity, Morningstar, and the international models, what is the real takeaway for the listener? To me, it's that the 4% rule is a heuristic. It's a mental shortcut.
Exactly. It requires continuous dynamic adjustments based on real-time inflation, changing tax codes, individual lifespan estimates, and the actual geographic and economic realities of where your assets are deployed.
Which leaves me with a final provocative thought for you to ponder. If the 4% rule relies entirely on the assumption that the future will look somewhat like the 20th century, what structural shifts are happening in the world right now that these historical spreadsheets are completely blind to?
That's the real question.
Think about the rise of artificial intelligence fundamentally altering labor markets. Think about the reality of global demographic collapse and aging populations shifting consumption patterns. Think about the rapid unwinding of global supply chains. Are we stubbornly applying a 1994 formula to a 2026 reality?
This material is a compilation of open projections and information from third-party sources and is strictly for informational and educational purposes. It does not present any ideological bias, nor does it constitute investment advice or financial counseling of any kind. Projections are subject to frequent revisions based on new information, external facts, and new narratives. Likewise, past performance is no guarantee of future results.
Thank you so much for taking this deep dive with us today, exploring the mechanics behind our money, understanding the why and the how. Not just the what is the absolute best way to prepare for whatever the future actually holds. That was today's Macroeconomy AI. We'll leave it here. You all stay well and keep an eye out for our new broadcasts. Subscribe to our channel, access the links, and follow Macroeconomy AI on social media. Bye.